Many of you have asked me to analyze a lot of the software-related stocks, talk about their AI disruption risk, which one is the most resilient, which one is the least resilient, and I'm going to be using the help of Anthropic to rank those stocks. And in my opinion, the best way of doing it is to ask AI itself what kind of stocks are the most vulnerable and which one are the most resilient. And I'm going to do it through an AI-related score, where I have a score for each one of those stocks, and I tell you a little bit more about each segment of the business, which one is the most resilient, which one isn't as resilient. And I'm going to talk about 3 popular stocks today. So I really hope you enjoy it as always. The first one is Adobe. Adobe is down 43% over the last year. Absolutely crazy. And the valuation got shot from 51 times earnings to only 11 times earnings. I've never expected that in my life, to look at Adobe and see the stock trading at 11 times earnings. And none of it has to do with the deterioration in the business, by the way. They're still growing 10.5% revenues, the same pace they've been growing at since December of 2022. So if there's any AI disruption risk, it hasn't made itself in the business so far, despite having Anthropic and having so many amazing AI tools and in ChatGPT and others, maybe not as advanced yet, but none of it has made itself in the income statement or in the company in general, which is why Adobe has been using this opportunity to buy back stock like never before. And they can buy back like 7 or 8% of the market cap every single year if they decide to do so. Now, for the Adobe disruption risk, it's a 6.5% score out of 10. And I'm going to tell you why. This is mainly for Photoshop. Photoshop, which is a part of, it is very popular part of the Adobe's business, is about 18% of the total revenue. According to Anthropic, the AI disruption risk is high, with a 7.5 out of 10 score. And there's some competition from Midjourney, Luminar Neo, and a few others. But there's also a potential opportunity from that, where there could be a generative fill and a professional precision, and mainly within Firefly, as Firefly has been expanding and has been growing rapidly, that could help counter the AI risk. The second one is mainly Premiere Pro, which is also facing some competition. This is 7.5% out of 10. And in total, they make up about 29% of Adobe's revenue, which has high AI-related risk. And they have other kind of businesses with the lowest disruption risk, and it's my favorite part, is the Document Cloud and Adobe Acrobat. This one is 12% of the revenues, and the AI risk is 3 out of 10. So it's a little bit of a mix for Adobe. They have some really good things, they have some bad things, but in total, the score is 6.5% out of 10. I believe, personally, most of it is priced in the stock, and Anthropic would tell you that itself. They would tell you that the worst case scenario is the revenue growth slows to 4 to 6%, and the multiple compresses to 15 times earnings. Yeah, we have Adobe right now, although it's on non-GAAP earnings, it's trading at about 11 times earnings or 15 times GAAP. So I believe most of the AI-related risks have likely priced themselves in a valuation. I think the valuation is too low to ignore. And although there are some risks, but I think a lot of it is priced in. And that's my quick opinion on Adobe. The second one is CRM. CRM is 26% down year to date. It's been a terrible performer, and the valuation also got destroyed from 84 times earnings to about 14 times earnings for CRM. And CRM isn't just due to AI. The business itself isn't really the best, and they've been decelerating in revenue growth from 28%, 24, 18, 11, 8%. This is not the case with Adobe, but this is the case with CRM. Now, the second reason why the stock is going down is due to, I would say, not much trust within the management team. So the CEO has not under-promised and over-delivered. He over-promised and under-delivered, which is the opposite of what you want in a CEO. And this was their target back in 2022, is to achieve $50 billion by 2026. Well, now we're in 2026, and based on the latest Investors Day, they're gonna target around $41 billion for 2026. So they missed their target by almost $9 billion. This is a massive, massive miss. And this is not a CEO or a management team that you could really trust in general. Now, looking at Salesforce, their AI score disruption score is actually lower than Adobe, which is great. It's 5.5% out of 10. This is due to a few reasons. The Sales Cloud is the most vulnerable one, making up 7.2 billion of revenues. Then you have Service Cloud, which is 8.1% of revenues. But you also have potential opportunities for Salesforce, mainly with their agentic related force, and they've been pretty much going all in the agentic kind of space. And the Data Cloud, which has low risk with a total revenue of $1.8 billion, and it's been rapidly growing, and it's growing actually like 130% year on year. The total score is 5.5%. I believe, again, the worst case is priced in within a lot of those stocks. So many people are looking at them and they say, oh, the AI risk is huge. Yes, maybe it is huge. Maybe it could affect a certain part of the revenues, but how much are you paying for that? You're paying 14 times earnings with Salesforce and 11 times earnings with Adobe. If you were paying 25, 30 times, I'm like, yeah, that's just too much. It's not priced in any worst case scenario. But if you're buying them at 14 times earnings and 11 times earnings, and some are trading double digits free cash flow yield with actually some growth and not that much in terms of an AI disruption risk, I think a lot of those stocks are undervalued. CRM is undervalued, Adobe is undervalued, even though they have the AI disruption risk. But I think a lot of it is actually priced in the valuation. Now, the last one is ServiceNow. ServiceNow has by far the least AI disruption risk amongst all of those stocks, which has surprised me a little bit. The valuation used to be extreme. It was trading at 111 times earnings. Now it's trading at 25 times earnings. And in this case, the business is actually doing really well. Their RPO, they're growing 26.5% year on year. They expanded customer relationships massively. They have over 603 total customers, and they've been expanding them a lot. The renewal rate is 98%. So people are satisfied with the services of ServiceNow, and they're keeping ServiceNow. Now, my favorite part about ServiceNow is the CEO. He seems to be like a really smart person, and he recently have canceled all his planned stock sales, and the CEO has purchased $3 million worth of shares, and ServiceNow didn't even move. The stock was up like 1% on the day. If we had better sentiment, I would have expected at least 10-15% on the day minimum. But I believe a lot of the algorithms are selling those stocks. Good news, bad news, anything that's software, they've just been selling them every single day. So, and the worst part about it, and the sad part, is that ServiceNow is a much better company, let's say, than CRM, but they're all going down at the same time due to the pressure from the algorithms selling everything that's software. They're selling them all at once. They're even selling Microsoft, which to me is crazy. And I believe at some point this is going to end. But the CEO himself, he's seeing an opportunity, and he's saying, this is a $1 trillion company in the making. I can't fathom a better entry point for what ServiceNow is building. This is one of one companies. That's not speculation. That's a fact. Now, of course, he's the CEO. He's going to be saying certain things, but also helps to get some optimism from the CEO whenever the stock is going down 40 and 50 and 60 and 65%. Now, this is the score for ServiceNow. It's 3 out of 10. So again, it has the lowest disruption risk out of all of them. It has over an 85% Fortune 500 penetration, which is really amazing. This is the scores for different segments of the business. The IT service management has the lowest score, and others have lower scores in general. But I want to talk about the business model a little bit better. And I think Anthropic did an amazing job at explaining it. And it says ServiceNow's platform is an orchestration layer that enterprise AI runs on top of, not underneath. When an AI agent resolves an ITSM ticket, that resolution is recorded, audited, and governed in ServiceNow. When a co-pilot generated code changes cause an incident, ServiceNow is the system of record. The more AI enterprises deploy, the more they need ServiceNow to manage it. So this is a completely different business model from maybe Adobe and a few others of the software-related stocks. And this is even a better explanation where it says every AI agent deployed in a Fortune 500 company enterprise needs ServiceNow to manage its incidents, govern its compliance, and audit its decisions. So this is more of a system of record, and those are the most resilient parts of the AI-related chain. Now, looking at the growth here, the growth is pretty decent, about 18 to 20% earnings per share growth. You're paying about 22 times earnings. This is not expensive at all, but you also have to take into consideration that this is non-GAAP EPS, and especially ServiceNow, all of them, but especially ServiceNow, it has massive stock-based compensation. So if you want to take the gap number, it's not trading at 22 and 23 times earnings. It's trading closer to 45, 47 times earnings. For 20% revenue growth, earnings per share growth, which doesn't make it seem as cheap as it is at the moment. Now, I still believe the stock's undervalued, and I did a deep dive on ServiceNow, but I said due to the extended valuation on GAAP numbers, if the company, or I should say, if investors want to value those stocks on GAAP numbers, you never know. Sometimes they do non-GAAP, sometimes they do GAAP. I would not be surprised if ServiceNow gets to $85, $87. That would be closer to 25 times earnings or one PEG ratio on a GAAP basis. On non-GAAP basis, it would be like 15 or 16 times earnings, which again, this is where CRM is trading at. This is where Adobe is trading at, even though ServiceNow is a much better business. But you never really know how Mr. Market decides to treat those stocks. And I think it's unfair that all those stocks have been selling them all together, despite some of them having much better AI resiliency in terms of their businesses than others. And I own one of them in my portfolio. And it's been going down with all of them, even though the AI related score on my stock is 1.7% or 1.7 out of 10. So it has the lowest disruption risk out of all of them. But it's also down 55% from a high. And it's sad to see, but I believe at one point this is going to end. I've seen certain setups before, and the algorithms are going to stop selling, and investors are going to step in at some kind of valuation. And I think there's a decent potential that a lot of those stocks will likely recover as fast as they went down. And that's my opinion on ServiceNow, Adobe, and CRM. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.